Hello, my name is Eric Wymore. I am a wealth manager and partner here at Metcalf Partners Wealth Management, and I'm here with this month's edition of the Metcalf Money Moment. This month, we're going to talk a little bit about the interest rates and the upcoming Federal Reserve meetings and what that means to your financial situation, including your financial portfolio. So again, to do a quick recap, the Fed Reserve has two mandates. They must have maximum employment, so they want to keep the unemployment rate low, and they want to provide price stability. So that is keeping the global or their inflation rate at 2% or less. One of the mechanisms that they do do that is to raise and lower interest rates. After a series of interest rate rises starting in 2022 and ending about this time in 2023, they have increased rates from 0% to about 5.25% roughly. Now there's a lot of talk as they meet here at the end of July, also meeting in September, of rate cuts happening. So right now, the CME Fed Watch has a probability of 100% that rates will be cut at the September meeting, by some kind of variation. What does that mean to you? Well, most likely, if they do cut rates, you will see an immediate drop in your money market interest rates. So if you've been earning about a 5% interest rate on your money market account, well, that will probably go down by whatever the interest rate cut is. And that is basically because those money market rates invest in very short-term paper, sometimes one day, sometimes 1 week. And if the interest rates drop, then they will renew it with a lower interest rate tool, an instrument. The other thing that you can most likely expect at some time, it'll be a little bit later, will be the bonds. What probably won't happen immediately is the interest rate decline in like your mortgages, your car payments, your credit card. That will probably take a little bit of time because that'll take a little bit more time to start seeing interest rate cuts or the interest rates decreases in those. Keep in mind, it takes about 12 to 18 months for an interest rate change, hike or cut, to enter the market. So it'll take a little while before you start seeing a lower mortgage rate, but you will start to see that. The other thing that can provide is how will your fixed income or bond portion of your investment portfolio react? Well, again, typically interest rates and the price of the bond have an inverse relationship. If interest rates rise, your bonds will decrease in price. If interest rates decrease or get cut, your bond prices will increase. So over time, you should start to see an increase in your bond portfolio. Now, how will the stock market react? Well, that's a good question. It's often said that the reaction is more important than the news. There could be certain areas of the market that do a little bit better with an interest rate cut. Think about like a small company that actually needs to borrow money to have their business, to run their business. They might actually see a little bit of a boost because now all of a sudden their borrowing costs are a lot less. But keep in mind, the reason that they're cutting is because they've, probably over tightened, and the inflation has kind of met its match and is coming down, but also because the unemployment number is starting to creep up a little bit. So that's just something to keep in mind. It doesn't mean that there's some kind of imminent change that's going to happen. It's just something to keep in mind. So regardless, most likely some changes happening here in the next few months, and between now and certainly the end of the year. So now is a perfect time to take a look at your portfolio to make sure you are set up to take advantage of what we believe are going to be some healthy interest rate cuts. As always, we appreciate your business, and if you have any questions, please feel free to reach out to one of us here at Metcalf Partners Wealth Management. Thank you.